Should I buy a property in a limited company or in my personal name? So let's get into this here because there is tax advantages and disadvantages depending how you look at it. So first and foremost, a lot of people will buy a buy-to-let property in their own personal name. And there's many who also buy property to renovate and sell who also do that in their own personal name. Now the problem with that is because of clause 24, which is otherwise known as landlord's tax, then as a buy-to-let property that you own in your own personal name, you're going to get taxed on the full income that you receive. So for example, if you buy a buy-to-let property in your own name, and let's say you're collecting £1,000 a month rent, then that means at the end of 1 year, because you have a buy-to-let property in your own personal name, you need to have a self-assessment tax return, and you're going to have to declare that you have collected £12,000 over the course of the year. Now, normally, what it used to be in the past, you would have tax deductions, such as the mortgage interest payment, the letting agent's fee, the building insurance, any maintenance and repair work. So you've got all those ongoing costs that you would normally be able to offset against the income, but not anymore with clause 24. So with clause 24, they don't care about those other deductions. So let's say that you earn £40,000 a year. So that would be what you earn in terms of your salary. But because you have to now submit a self-assessment tax return because you own one buy-to-let in this example, then you're going to put the £12,000 on top of the £40,000 that you already take home. So that means your income shows as £52,000 when you add both together. And that's going to bump you up into a higher tax bracket, that you're going to pay more tax, and you don't have the tax deductions of all the costs of owning that property in your own personal name. So imagine you then go and buy property number 2 or property number 3 and you do this in your own personal name. The problem there is you just keep on adding to your income and not getting the benefit of tax deductions, which means you're going to pay a lot more tax. Now, it's very different if you just want to have one or a couple of buy-to-lets, because it's advantageous buying in your personal name for the only reason is that you get normally lower interest rates in the sense of what you'll pay as a buy-to-let mortgage in your own personal name. But there's restrictions with buying property in your own personal name, because not only the tax situation, which I've just explained, but you're only able to get so many mortgages with any given lender, because then what happens is you end up having too many buy-to-let mortgages, and because of the tax issues, you're going to find that you're going to get restrictions of more lenders wanting to lend to you as a person. So I don't see any advantages whatsoever to buying in your own personal name. And you're maybe going to ask, well, what happens if I already have property in my own personal name right now? What's the strategy there? We'll talk about that in a moment. But when it comes to your next investment, you need to think a bit more longer term. And this is what's caught so many people out, especially accidental landlords, because you never meant to be a landlord, but now you have a property where you're collecting rent from, and you might not have a lot of cash flow, which means you're going to really pay in the tax. So we need to have a plan going forward on how we fix that portfolio. But more importantly, if you do want to invest in property and you want to build a portfolio, you absolutely should be doing it within a limited company. Because inside the limited company, you can offset all the expenses. So you have income that comes in and you've got expenses that goes out, and you're only taxed on profit. And at the moment, that's at 25% in terms of corporation tax. But up to 50,000, it's only the 19%, and then it starts to go over into 25%. But just keep it super simple and say it's 25%, right? So again, from that point of view, if you make £100,000 profit, you'll be paying the best part of 25k in tax as corporation tax. Now, the good thing about owning property in a limited company is that you have those deductions like I mentioned, but it's a company. You can have a lot of expenses that you can offset. You can have expenses to offset on trips and holidays, and you might go, well, that's a holiday, but of course it's a business holiday, isn't it? And what about going out to restaurants to, speak to potential JV partners and, potential investors and your coffees and, paying for a whole bunch of your subscriptions and certain business expenses that are all tax deductible. So it means that your profits that you have in a business, you can still offset that against tax deductible expenses, which drives down your profits. So it means less tax that you pay on that there as well. So it's more advantageous to run a business for the tax advantages. Now, some people say, well, getting a commercial buy-to-let mortgage against a limited company, the problem being is interest rates are a bit higher. Now, of course, interest rates are a bit higher, but I can guarantee if you run through a scenario with your accountant, it would be much better to paying a little bit more in in terms of the interest rate than it would be holding that property in your own personal name because of the tax disadvantages. Now, what to do if you have property in your own personal name just now? Well, there's two things you can do. There's actually three. So the first thing is you can sell that property. Now the problem being there is you've now got capital gains tax. Now the good thing about capital gains tax is just recently with what's been suggested at the budget is that capital gains tax is going to be getting reduced to 24%. So from that point of view, that's a lot better than it was previously. So if you were then going to sell that property, you can offset expenses, maintenance, repair work, everything you've done, and you just get paid you just pay the capital gains tax on the profit. And of course you have, your own capital gains allowance and your partner's allowance to deduct that from the profit, so it'll reduce your capital gains allowance that you'll pay on that property. So that's one way of selling it. But you might want to keep that property. If you want to keep it in your own personal name, you need to look at the tax disadvantages on yourself in terms of your income, and I always recommend you speak to an accountant to see that situation, how you fix it. Or you can sell it to your limited company. Now you actually physically need to sell it. Now, because you're effectively selling it to a limited company, there's a lot of buy-to-let lenders out there that you won't need to put a deposit down for it because they know it's your property that you're selling to a limited company. It really depends in it's the finer detail. And again, speaking to, your accountant and a good mortgage broker such as expressmortgages.co.uk. Express can help and support you with buy-to-let mortgages in a limited company, especially if you're having to sell it from your personal name into a business. And of course you'll have stamp duty to pay, which will depend on where you are in the UK, what percentage that will be. But there's advantages of that from a tax perspective, because if you keep it your own personal name and you do that for the next 10 years as an example, then your accountant will show you how much tax you're going to pay over those next 10 years based on your salary increase over that period of time as well. But then when you look at the cost of paying stamp duty and the cost of legal fees to sell it to a limited company, sure, it seems like an upfront cost at the moment that you're going to have to pay, but over the long term, it's going to be significantly more beneficial for you to save money against the tax that you're going to be paying. So this is why it's always good to have a great accountant that can review your personal circumstances situation to see whether you should just keep holding the property yourself, whether you should offload and sell, or then sell it to your limited company, still retaining it and collecting the income over there. The reality is if your property is not producing enough cash flow, like bringing in enough money from paying expenses and got good cash flow, you probably should offload that property and then start thinking very differently with the right investment criteria. And that's something that I cover in my book, Your Property Jumpstart. You can get a copy of this for free. Just head over to propertyjumpstartbook.com and grab a copy. And what I talk about in here is talking about setting your investment criteria to help you make better investment decisions. So you know exactly the type of properties to buy in the right locations, at the right level of, in terms of negotiation and how you make the right offers and what's the right strategies, how do you finance it, but how do you know in terms of cash flow and the time it takes you to get your money back out, which is recycling the money that you bought the property with. That's the whole buy, renovate, refinance and repeat strategy. And by doing that, one pot of cash can build you a multi-million pound property portfolio. And of course, what I love about buying property in a limited company is you've got access to way more lenders. It opens the door to so many more options, which means you're never going to be in a situation where you can't get any more buy-to-let mortgages, but you can get so many more within a limited company. So there's so many benefits, especially tax advantages. And here's the other thing, if you're going to flip property in a limited company, you don't have capital gains tax to pay in a limited company, you just have corporation tax. And like we said, corporation tax, you can reduce that with all your expenses and tax deductible business expenses to reduce the tax that you pay, which means more take-home money for you. And that's the name of the game, isn't it? When you're looking to invest, you're looking to invest for a return and make more money, buying property for the long term because you know it's going to go up in value, but more importantly, saving the money by being taxed, having the right tax strategies to make sure that you're mitigating the tax and keeping more profits for yourself. So this is why, as always, I recommend is to buy property inside a limited company. So if you get any questions on the back of this, pop it into the comments below. I'll be sure to go in there and respond and help you along your way in your journey. Like I said, maybe grab yourself a copy of your Property Jumpstart. Head over to propertyjumpstartbook.com and get it for free. Until next time, all the best.